here we are with yet another one. We got a one everyone's been looking forward to in Netflix stock. I'll just tell you, this is not a good looking stock chart here. I don't know if anyone's seeing what I'm seeing, but that looks like you're on vacation in the Bahamas and you're jumping off a mountain into the lake. Don't know if that exists in the Bahamas, but it's one of those, you know what I'm talking about. You jump cliff diving. We've all been there, except for me because I actually personally don't enjoy death. So I've not been there. But stock's down 10.5% after hours. Son of a gun. So really negative reaction. Obviously, as I've mentioned before with this stock, the real main thing they're tracing here is going to be subscriber growth, because that was some fear that prior to the pandemic that ultimately boosted their subscriber growth to a significant margin. They started to slow down in terms of subscriber growth. They were gaining a lot less every single quarter. In one quarter, even lost subscribers. So that was a concern. Now, 2020 benefited them massively, and they were able to bump up. And you look over the last year, and it's been pretty favorable for the stock. Can't lie to you, up 26%. Obviously, one thing you'll notice is, did you see a single in March of 2020? Look at their dip only. I mean, we're talking about a dip of 10%, where other companies faced a dip of 50%. But in the same time period, since that dip, the stock's up 65%, which, all things considered, not crazy. But in the last 5 years, stock's still up 500%. I mean, that's massive growth there. But again, the expectations are high, so if they don't meet those expectations, you'll see a plummet like this. So my assumption is it's likely a miss in terms of subscriber growth. I have no doubt in my mind this is a company that's going to beat that is consistent with their revenue line, usually puts up good numbers. EPS line, they're starting to get very profitable, so we'll just see what's going on. So they have a GAAP EPS here of $3.75, which is beat by 78 cents. It's a massive beat in terms of a profitability standpoint, so really nice to see that. Revenue coming in at $7.16 billion, which is up 24% year over year. It's a beat by $20 million. That's pretty significant. I can't lie to you. That is pretty significant. Guidance, they're expecting revenue of $7.3 billion. Versus a consensus of 7.38 and an EPS of $3.16 versus a 2.68 consensus. So overall, it's positive. Positive in terms of that EPS line, but revenue a little bit short, so that could be part of it too. Paid memberships, they're expecting 208.64 million compared to 214 million guidance. So quite a step down, I can't lie to you. And for the next quarter, they're only expecting to add 1 million subscribers versus a consensus of 4.28. Now, personally, in my opinion, I don't think that's too shocking, because, again, people are going to start getting back to work. They won't have as much time to necessarily use these subscription services. So, once they stop paying you $600 to sit on your tail every month, then maybe people will, get back to work. Won't have as much time for this. So overall, though, kind of disappointing compared to guidance for sure, but nothing super crazy. So, first quarter report came up light in guidance, obviously. Revenue rose 24%, pretty nice. Company logged 3.98 million global net paid additions, which is pretty good. But again, the guidance was 6 million and the consensus was 6.29. So not only did they miss their guidance by 2 million, which is significant, they missed the consensus by even more. So definitely that's why this stock's down. That's quite a miss, but all things considered, not that bad. I still think 4 million it's decent in terms of ads for the when you're talking about how many subscribers they have here. 200 million is quite a bit. So, but definitely a big miss. I think the guidance was a little bit too steep for them. Paid membership growth slowed due to the big COVID-19 pull forward in 2020. the lighter content slate for the first half of the year. Obviously, they say it's due to production delays, but frankly, we all know what it is. Netflix, they're not investing as much into original content as they probably need to right now. All their competitors are going really big. I could have said another word there that would have been made it sound a little gross, but they're really going into these original content. Every other service is. So Netflix needs to get on it. I mean, Stranger Things hasn't been out for 3 years now. Their main winners right now, it's not original content. It's the old series they've always had. Series from people's past that they've been rewatching while they've had additional time. So they lost The Office, obviously a big blow to them, but they still have some classic sitcoms that a lot of people do watch. So there's uncertainty. In the long term, the rise of streaming to replace linear TV is a clear trend, as they want to say. But definitely weak guidance. I mean, good grief. Weak numbers here. Let's look at my glasses. Shareholder letter. That's what we get, as opposed to a non-shareholder letter. Sorry, I don't know what I was saying there. That's what we get as opposed to the press release. Netflix is very cryptic around the press release. Doesn't necessarily exist. So we get a shareholder letter. So you see the revenue line here from Q1 2020, 5.7. I mean, this is consistent revenue growth, no doubt. Forecasting 7.3, obviously, in the next quarter, which is a little bit definitely a lot less steep of an increase as you might expect compared to previous results. Year-over-year growth of only 18% as well. So operating, really, I care more about the net income line. Net income line has been growing as well. So obviously we saw a little bit of dip in Q4 last year, but this quarter at 1.7 billion, pretty massive. Expecting 1.4 the next quarter. A little bit of a decrease. We'll see what that looks like as well. Global paid memberships only expected to be a year-over-year growth of 8% for the next quarter. This quarter they brought in 13.6, which is obviously quite slow compared to what you saw in 2020, but it's not a shocker. 2020 each had 20% plus growth. A little hiccupy. Net ads only expecting 1 million is freaking weak compared to what you've seen. Q1 of last year they added 15.77, so million, and this time they're expected to add 1. So again, difference between pandemic and non-pandemic, so you have to come to expect that. It's not too crazy. At least they're not expecting a decrease. Now if they were to see a decrease next quarter, things are going to get very hairy for this stock. I'll just tell you that right now. People are going to sell out. It's going to be another 10% dip. I can guarantee it. So hopefully they manage to not do that. So net ads versus forecast here. Again, you see it's a pretty big mix. Typically mostly green, but there are some big misses on here too. But there's some big ones. Big green wins. Weekly global paid net ads. You can see here the 2021 forecast is low. If you look out through through really the end of the quarter, it's low compared to what we've seen over the last few years. Even 2017, 2018, 2019. I mean, it's significantly lower than those. We're talking about half the rate of those even. 2020, not even just comparing to 2020. They talk about product competition, everything of the sort. If you look at different region, it's always fun to see different regions. The revenue here in United States, Canada, consistent growth there, obviously. You see consistent growth. Absolutely good to see. So EMEA, consistent growth as well. So nothing super crazy there. Latin America did see growth as well. Pretty good growth, all things considered. In Asia Pacific, China, also growing pretty well. So again, growth is good to see. You like to see that. I do think that they have an investor balance sheet. Hear me out. I love the balance sheet. I look at a balance sheet. like it's a beautiful thing. I worship the balance sheet. Okay, I live to read the balance sheet, and I hope you do too. So let's take a look here. Total current assets coming in at $10.1 billion. That compares to 9.7 of it was only 3 months ago. So 9.7 of 3 months ago. Total assets in general at 40.1 billion compared to 39.2 billion of 3 months ago. Current liabilities 7.9 compared to 7.8. So not much changing here in this balance sheet, all things considered. Total liabilities 27.2 billion compared to 28.2 billion of 3 months ago even. So balance sheet did grow, actually. Stockholder equity, even in a 3-month period, went from 11 billion to 12.8 billion. So quite an improvement, actually. The balance sheet's growing for this company. Looks pretty good. I like to see it. Now again, valuation of the stock, pretty crazy. PE around 100. Market cap on this thing of 240 billion. Some might say is pretty expensive, but I don't think it's too crazy. The company's likely going to bring in, I would say, close to $30 billion this year. Should be a little bit over, probably closer to $35 billion. So it's not an incredible stretch of valuation by any means. We're talking about really just around 8 times that value. I mean, it's not crazy, or 7 times I should say. So not crazy in terms of the market cap, but P/E ratio a little bit high. Again, this company, as I mentioned, it's got to stick to the growth plan. That's the only way it's going to stay ahead of the game in terms of the stock price here. And they need to beat that 1 million consensus next quarter. But we'll have to see that guidance and what they posted this quarter. So we'll see what it looks like. But so far, they're not projecting some good numbers.